Welcome to LeonCo and welcome to another video here on our channel. For the year 2021, we decided to have our focus more on investing. And with that in mind, we decided to start a new series in which we are going to start discussing some of the companies that we have in our portfolio and others that we're thinking about adding to our portfolio. And we're going to break them down on how we pick these companies, why we pick these companies, and why do we believe they are good investments, and why I believe that we have them in our portfolio, and we strongly encourage you to check them out and figure out if they work for you. So for this first video, we decided to start talking about a company that we still don't have in our portfolio, but we're currently working on adding them for the year 2021, and that is Bank of America. So since we don't have it in our portfolio, we decided that we would bring a person that is investing in Bank of America and has a little more experience with the topic of the stock and is more familiarized with Bank of America and its whole as a company. So we decided to bring on our friend of our channel here at LeonCo, and Orlando is going to talk about what Bank of America, how he invests in stocks, how he picks stocks, and all those interesting stuff about investing, and specifically on Bank of America. So we are going to pass the mic to Orlando so he can talk about and let us know about more about investing in this stock.
Well, hi to everyone. As Emmanuel said, my name is Orlando Mortel. I invest in Bank of America for about 2 years now, and I've been very interested in the company, and I've been tracking it to see how it performs. I have to be honest and say that my analysis begins and ends with the teachings of Benjamin Graham, the author of the Intelligent Investor book, and Warren Buffett. So according to those two people, investing consists of equally three elements. First of all, you must thoroughly analyze a company. Second element, you must deliberately protect yourself against serious losses, and that means that you need to have a margin of safety. That is something that Benjamin Graham discusses thoroughly in chapter 20 of his book, The Intelligent Investor. The third element is that you must aspire to adequate, not extraordinary performance. And this may be controversial because, of course, everyone wants to invest in stocks or companies that become home runs every single one of them. And an intelligent investor may aspire to just adequate, not extraordinary performance, because at the end of the day, you just want to get your goals done. So that must be your first priority. So one other item that I really have in mind when analyzing a company is that a company must have very good management. You may have a very good company, and if the management of that company is not good, to say the least, it becomes a bad company. So to be an intelligent investor, you must also refuse to judge your financial success by how a bunch of total strangers are doing. So you must concentrate on yourself and how you do better from the day before, or from the month before, or from the year before. In the end, as I said, what matters isn't crossing the line before anybody else, but just making sure that you do cross it. So to begin our analysis, we'll begin talking about Bank of America as of August 2019. In August of 2019, people started comparing Bank of America to JP Morgan Chase, as those two were two of the big four banks, JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. Bank of America and JP Morgan Chase were the two that were doing the best. So JP Morgan Chase, as we all know, is a business that is doing quite well all around. JP Morgan Chase has the number one market share in global investment banking fees throughout the first half of the year, as of 2019, of course. Uh, but the bank currently trades, as of August 2019, the bank traded for about 1.45 times its book value. And Bank of America, in contrast, was trading at 1.015 its book value. So Bank of America was trading, or to say it better, had a lower price to book ratio than J.P. Morgan Chase. So in that maybe ambiguous analysis, Bank of America was the winner, to say the least, in that sense. But in a nutshell, J.P. Morgan Chase, yes, is an expensive bank stock, but of course you get what you pay for. You pay more for J.P. Morgan Chase, but J.P. Morgan Chase was doing a bit better, so it was a good investment nonetheless. Now, with Bank of America, it's tough to make the case that any other United States bank has done a better job of turning things around since the financial crisis than Bank of America. I mean, Bank of America continues to improve to this day. Bank of America's second quarter return on equity, or ROE, and return on assets, ROA, were of 11.6% and 1.23% respectively. Those are not only strong numbers, but they're a big improvement over the 10.8 and 1.17 figures it posted in the same quarter a year earlier, in 2018. So when you observe Bank of America from those standards, it's improving compared to JP Morgan Chase. Finally, while the other big banks have had a, let's say, very bad year, or even a negative growth in key areas of their business, Bank of America hadn't had this problem. The bank grew its loan portfolio by 4% over the past year. That's twice the growth rate of JP Morgan Chase during the same period. So, in short, Bank of America may not be quite as profitable as JP Morgan Chase, but it's certainly getting closer. So let's go to the next year. As of October 2020, people, or let's say some stock analysts, started comparing Bank of America to Wells Fargo, because as of October 2020, out of the big four banks, Bank of America and Wells Fargo were the worst that we're doing, to say the least. Both banks are heavy commercial players and will see pressure on their loan margins as a result of the loan interest rate environment given by the Federal Reserve. Both have also have strong capital and liquidity positions. Where Bank of America will be able to perform better is in non-interest income, which has been powered by strong investment banking fees and sales and trading activity. But Wells Fargo has a, let's say, quite big problem when compared to Bank of America. And as some of you may know, Wells Fargo had a fake account scandal. There's even a big Netflix documentary about this. So Wells Fargo has a 1.95 trillion asset cap that the Federal Reserve placed on it on 2018, as I said, following the fake account scandal. So, a Deutsche Bank analyst named Matt O'Connor put it very well. He said, and I quote, "I think February it's going to be 3 years, which investors ask me, like, how long I think it's going to linger. And I'm like, I don't really know, but there's been 4 CEOs, 3 shares, 3 years. There's obviously been like a lot of change, a lot of effort." That ends the quote. So, with that in mind, as Matt O'Connor said, yes, Wells Fargo is certainly, putting in the effort and working a lot, but that, first of all, scandal, and second of all, Federal Reserve monitor of their accounts, it's putting a big cap on it, like a glass ceiling. So at the end of the day, Bank of America doesn't have that problem, and a conclusion might be that Bank of America is one of the safest of the big banks, in my opinion, and is still only trading, or was only trading, at about 85% of its book value in October of 2019. So when comparing Bank of America to Wells Fargo, that Federal Reserve cap that Wells Fargo has, it's a big loss for them. So going to December 2020, some analysts started comparing Bank of America to JP Morgan Chase again to see if it was still a winner investment for Bank of America. So let me say first that I think that out of those two, Bank of America, it's still the better pick because of diversification. And well, I will explain myself. Both JP Morgan and Bank of America have lost due to the coronavirus pandemic, as we all know, 10.1% and 14.9% respectively year to date, with Bank of America losing more. Both banks are substantially diversified, supported by solid revenue mix, and also both are on track to expand in new areas of opening branches. And here is the part where we need to be very analytical. JP Morgan Chase's total net revenue grew 4% from the prior year level, while that of Bank of America recorded a decline of 5%. So with that fact, you might think that Bank of America, it's a no-go for investment. But let's watch this next fact, which might be a bit controversial too, which is about diversification. So while both banks are considered too big to be allowed to acquire another bank, as Bank of America did in the financial crisis of 2008, there are no such restrictions on expanding other businesses via acquisitions. With that in mind, JP Morgan is taking measures to further diversify operations, while on the other hand, Bank of America is just making organic growth efforts within the company and isn't doing much to further diversify its business through acquisitions. So with those two facts that I mentioned, yes, JP Morgan Chase may be the better choice. Another fact that may favor JP Morgan Chase over Bank of America is that JP Morgan Chase has authorized to repurchase shares worth up to $30 billion for 2021, while Bank of America, as of December 2020, was yet to announce any buyback plan. So at this point, Bank of America isn't that far from JP Morgan Chase as of this decisions, according to diversification and the buyback plan of shares. But I think, just as a personal decision, that there is a very, let's say, big or important component to consider, or element, and that is the stock price. So while we are comparing JP Morgan Chase, which is the biggest of the big four banks, and Bank of America, as of today, the JP Morgan Chase stock is of about $120 per share, while the Bank of America share is at about $30 per share right now. So when you buy Bank of America, you might be just buying the very same as JP Morgan Chase, but at a sale, let's say, in my opinion. Just to conclude, another very important component to consider is the return on equity, the ROE of each bank. So, for those of you who might not remember or don't know, the ROE, the return on equity, is a measure of a company's efficiency in utilizing shareholders' funds. So, for every one of us investing in any company, the return on equity is something we have to be very attentive to. So the ROE, the return on equity, for the trailing 12 months for JP Morgan Chase and Bank of America is 10.85 and 8% respectively. Further, both companies, in other words, both banks, outpaced the industry's average of 7.87%. So with this in mind, both banks are extraordinary choices to invest in. With this last, let's say, facts, JP Morgan Chase may be the better choice, but when analyzing, in my opinion, those banks since 2019 and observing how they transformed themselves, Bank of America seems to me the better choice. And the component that it's not the first that I see, it's not the first that I look at, but it might be the definitive factor for you to decide is the stock price. So as I said, Bank of America is trading a lot lower compared to JP Morgan Chase. And one last thing, JP Morgan Chase is trading at about a book to price ratio of 1.5 versus Bank of America today, which is trading at about 1.01 price to book ratio. So right now, yes, I am investing in Bank of America, but I am waiting for Bank of America to, let's say, lower its stock price to, let's say, $27 to $28. When that point comes, you may be sure that I will buy every stock that of Bank of America that I can buy, because if my calculations are correct, Bank of America will have a price to book ratio of about, let's say, 0.70 or 0.80 price to book ratio. That means that, in the technical terms, I may be buying $1 for 70 cents. And in my opinion, that's a very good deal or great deal. So to say the last things, if Bank of America reaches, let's say, $27, $28, $29, it may be a good thing to look at that price to book ratio and consider all the good things that Bank of America offers. And like I said earlier, and this may be very important for some of you, Bank of America may not be the home run you want. Bank of America may not be the stock that you pick and all of a sudden you become a millionaire, but Bank of America is that stock that you choose and it becomes a stronghold for your portfolio. It becomes that stock, that investment that year after year you look at and you say, hey, I'm satisfied, because not only its stock price evolution, but the dividend that you receive will be great. That's a very important factor. Bank of America has been delivering dividends consecutively for the last decades. Even in the financial crisis of 2008, I may say, Bank of America continued its dividend. It never shut down its dividend. Even though it was just 1 cent per share, it still continued paying its dividend. So that's another very important factor for me to consider, because if time comes, if the worst comes and the market just crashes and doesn't go up for the next 10 years. You want those dividends to keep you alive. So that's another factor that you will have with Bank of America. So with that all in mind, that's all for me. And because all of this that I have told you, this is why I chose Bank of America.
So this is a great way for you guys that don't necessarily have that much information about companies. We will be sharing with you guys, try to share with you guys weekly about different companies that you can try to invest. Some of them are in our portfolio, some of them are not, or are still in standby to be part of our portfolio. But we just wanted to give you some analysis more in depth about why we pick these companies and why are they so valuable for us, and we think that they could be valuable for you guys. So this is more of a technical standpoint for those of you who like more technical information about stocks. I hope you guys enjoy this. I hope you guys are staying safe, staying healthy, and always remember to have that king mentality.